How have we been? How has the mentorship session been so far? Okay, beautiful.
Beautiful. So today we're going to be talking about one of the most difficult aspects, one of the aspects that a lot of entrepreneurs do not like is the numbers. Again, your facilitator will take this session. Unfortunately, she could not make it today. Like I mentioned last week, your facilitators from Deloitte are currently experiencing their end of year at the moment. So they have a lot of activities and a lot of things packed. So they would like to extend their apologies for this. So I would be taking the financials today and I'm very excited about it. I want to break it down so well for everyone so we can really get it because this is the most important part. Once you get this part, I think every other part is just kind of backup because the first thing maybe your investor or anybody who wants to fund you would look at is your financials. So now we're going to be looking at four major sections, right? The first is the cost breakdown. The second is the revenue model. The third is your financial assumptions and then your 3-year financial projections. Now, this seems like a lot of English, right? But it's something that you already know, it's something that you're already doing. And I want to, break it down so easily that you can see that it is something that you can do, right? And after I'm done breaking it down, maybe I'll take a few questions and then I would show you an example of my personal financial, would I say, projections or a financial template that I did that helped me secure funding. So are we ready? Let me know in the chat if we're ready to get started. Let me know, let me know. Even if you want to unmute your mic. Let, okay, yes, we are ready. All right. So basically, cost breakdown. What is it? I know we've been hearing cost breakdown, cost breakdown. What exactly is cost breakdown? It is very simple. They're basically asking you how much do you spend every day on your business or how much are you spending on your business constantly? These are just your expenses, right? And in financial language or in business, there are two major types of cost, which is your fixed cost, and I want us to pay attention. Your fixed cost and your variable cost. I want us to all in the terms. That's why I'm using most of the terms, right? You have your fixed cost and you have your variable cost. Now, what is fixed costs? Are the costs, or this is the money you spend consistently on specific things, right? For example, your rent. This is something you have to pay every year or every month. Another thing is maybe staff salaries. This is something that you have to pay every month, right? Or for some people every week, or for some people weekly, right? So you can see those fixed costs are those things that you have to pay constantly over. It could also be your subscription. For example, if you have a software, right? Maybe if you use Zoom, for example, for meetings with your team, every day you have to pay Zoom like $20, right? So that is your fixed cost. The next type of cost that I mentioned is the variable cost. So these are the costs that vary, right? You may not be spending every month for it. For example, your raw materials, right? You may purchase raw materials in January and you will not purchase again maybe until July. You can see it's not so consistent. It could be your packaging materials, it could be your delivery cost. It changes from time to time, it is not fixed. So when it comes to your cost breakdown, you need to know these two, right? And by knowing to the simple thing that you have to do is get a piece of paper and write them down. Okay, rent, this is how much I spend on rent every year. Salary, this is how much I spend on salary every year. So that is basically your cost breakdown, calculating the amount of money that you spend in your business. I don't know if we're understanding. Did we get that? Did we get that? So that I can move on to an example.
Yes, very well.
Okay, beautiful. Beautiful. So now to even explain the cost breakdown further, right? Let's imagine, or let me imagine that I run a skincare business, right? And I am selling a body butter, right? I run a skincare business and I'm selling a body butter. Now, what are some of the costs associated with this body butter? I know that I'm going to buy raw materials. I will buy shea butter. I will buy my essential oils. I will buy the containers that I'm going to, put this product in. How much do these things cost? I'll put it down. My stickers or my branding, I'll put it down. The delivery fees that I'm paying, the data I'm using, the lights that I'm paying for monthly. If I'm putting fuel inside generator, I will put it down. If I'm paying for social media graphics, right, I will put it down and now add everything so that I will get the total monthly cost. Do we understand? So it's just basically making a list all of these things, right? So that you know the total amount of money that you spend maybe monthly or yearly. That is simply cost breakdown. So by the time you now have the answer, or let me even make this more interactive so that I'm sure we're following, right? Can someone just unmute and let me know an example of costs in their business? Okay, go ahead.
Okay. From what I have here,
Okay.
like the cost breakdown, which I stated down from my angle, I have the variable costs, that's the cost of producing or purchasing my products, which I sell to my customers.
Yes.
So they vary from my suppliers
Mm-hmm.
to the quantity and quality of products I buy.
Yes.
So the
So
shipping cost of transporting them over from where I purchased it over to my shop varies also from the
yes.
weight of the products to the distance and the methods.
Mm-hmm.
So for my fixed cost, we have the warehouse, the
Okay.
storage space. It
Mm.
remains constant. Like the rent
Yes.
for the warehouse remains constant. It's
Yes.
changing over time, but it's always constant.
Yes.
And the salaries and benefits of employees I employ for my
Yes.
workforce.
Yes, that is beautiful. That's a very beautiful example. I'm glad we're following. Does anyone else want to try? Cafe Orange, do you want to try before we move on to revenue model? Does anyone else want to try? Just let us know what are some costs that you incur in your business. Okay. So nobody wants to try. All right, that's fine. That's fine as long as we're following. So now the second thing we're looking at is revenue model. This is simply how does your business make money, right? And in revenue model, there are things that you are considering. So I'm going to be using, I think I'll still use the skincare example, but then we're thinking of, or the thing I want us to have in mind is, okay, your network is bad. That's fine. You can type it in the chat. If you can't talk, you can just type it. I just want to be sure that we're following. So when it comes to your revenue model, one thing I want you to have in mind is your unit pricing, first of all, and the number of units. So unit pricing simply means for one of your products, right? What is the price of one individual product? I wish, okay, let me use a pen. So what is the price of your individual product, and then um, the number of units that you need. So how many are you selling per month? So these are the things that we consider in revenue mode, right? And then you're now thinking, is it something that you're doing? Okay, is it a one-time sale? Is it something that you're doing subscriptions for? Is this something you're doing service fees for if you're a service-based business? Now, the math is very, very simple, right? Remember, we're talking about unit pricing. How much does this product cost? And then how many of these products are we selling in a month? That is number of units. So units is like a piece, just to make it clear. So now if we're a skincare business, just going off the first example that I use, and I sell a product for 5,000 naira, that is the unit price of this product. And each month I sell to 100 customers, right? That means each month I am doing 500,000 naira in revenue. Let me take that again. If I sell one of my skincare products, let's say the body butter that I was talking about earlier, and each month I am guaranteed, or I know that I have up to 100 customers who are coming to buy this product, right? It means that every month I'm doing 500,000 naira in revenue. That is simply what the revenue model is about. It's about how much you are selling per month. What are you selling every month? And to go a little bit deeper, there's something we call seasonality, right? Where maybe in January, you're not selling as much as you're selling in December. Let me use an example. For example, if you sell maybe tomatoes, right? Maybe January, you're not selling so much. But December, because of the Christmas period, right, there's a peak in your sales. These are just some things that you consider when, putting or doing your revenue model. Don't worry if it's confusing right now. I am going to show you an example of a financial sheet that I did so we would understand even better. So, like I mentioned, revenue model has to do with your unit price, how much you are selling one, right? And the number of products you are selling per month. So when you're able to figure it out, this could be if you're already an existing business, right? And you are selling products month. This is why keeping data or keeping records is very important, so that you know every month this is how much I'm selling. So that when you come to your projections, because all of these things we're doing now, the whole purpose of getting all this information is for us to be able to do our projections. Projections is simply an educated guess, right? So you're not coming here to tell us something that is impossible, but we can see that this your projections or the way your business is growing. We see that, okay, this year, this was how you grew month on month, right? So the next year or the next 2 years, you can do this. And we can bet on you with our money that if we give you this money, you can actually do this thing that you are saying. Do you understand? So when you know, okay, the number of units you sell every month and the price, you'll be able to know, okay, this is how much I can do every month. And then you'll be able to project. I don't know, is revenue model clear? Do we understand revenue model?
Yes.
Okay. All right. Beautiful. So now we're going to go to our financial assumptions. So, like I mentioned, your financial assumption is an educated guess, right? That you use to forecast your numbers. And there's no way you can take this educated guess if you do not know your cost breakdown and you do not know your revenue model. So now we know our costs and we know our revenue. We know how much we're spending on the business. We understand our profits. So now this is where we can now take a financial assumptions, right? Let's say um, every month you notice that you have a 10% growth, right? That means every month you're getting 10% more customers in your business. you will now be able to calculate and say, okay, this is January or this is April. And I know that every month from January, February, March, I've seen a 10% increase in my customer growth. So when you're projecting the other months, you will be able to project a 10% growth over those months, right? Let's do the numbers. Let's do the numbers. Let's say this month, or from January, you had 10 customers. 10% of 10 is what? Where are the mathematicians in the house? What is 10% of 10? Let me see if we know math. Anybody? Hey, nobody wants to fail. It's 1. So let's say every month you get 10% customer growth. That means you're getting 1 customer increase every month, or you're getting 1 sale increase every month. So let's say in January, 10%. February, you got 1 extra sale. So you're selling 11 in January. In February, sorry. In March, you're doing 12. In April, you're doing 13. In May, you've done 14. So that means month on month, you're having a 10% growth. So you know that every month you're doing 10%. So you can project that by June, you're going to have 15. By July, you're going to have 16. By August, you're going to have 17. So that is basically projections. It's an educated guess based on previous activities that have gone in your business. Do we understand? Do we understand?
Yes.
Okay. Only one person is answering and saying that you understand. So I hope all of us understand. Anyway, that is what financial assumptions are, right? So this is not like you just selecting any random number, right? They're actually based on logic and they're based on data. It is something that actually makes sense, that is actually achievable. So once you have all of this information, then we can now go to your financial projections, right? Where you can say, okay, this year 2024. Okay, your network is bad. That's fine. That's fine. This year, 2025, we are going to do 1 million naira in revenue. We can see that our expenses is going to be 800,000, and we can see that we're going to do a profit of 200,000, right? Then, because you already know how your business is going to grow month on month, there's a calculation for all of these things. Then you'll be able to say, okay, based on what we have done in year 1, this is how year 2 is going to look. Maybe year 2, we're going to do 2 million, 1.6 million in expenses, and probably 400,000 in profits. You understand? So this is how projections go, right? To keep it simple to understand. But for us to even understand better, let me share the document that I promised to share with us so that we can see the full capacity of everything, right, that needs to come together for you to do your projections. Let me see if this is it. Okay. All right. Let me know when we can see my screen, please. Let me see if we can see it. Okay, can we all see my screen? The screen I'm sharing. Let me know if you can see the screen.
Yes, I can say it.
Okay. All right. So this is the financial model template that we were given from TEF. to do our financial projections or our financial modeling. So I will just be walking us through everything practically. So we can see down here that there are different sections, right? So we have the instruction first, and I think we should go to the glossary so that we can understand some of the terms before I go deep into everything. So you would see things like opening inventory, right? You see things like initial working capital. You see things like benefits, like business development, direct costs, factory overheads, administrative, receivable days, payable days, inventory days, grants, equity, debts, right? So let me just define it for us and hopefully would remember as we go through the financial model template, right? So first, inventory. This is the allocation of purchase of initial stock of products for sale or service to be delivered in the first few months of operating the business. I think opening inventory is pretty open, pretty clear. That's like the first amount of products that you buy. Maybe for our hair care person, maybe you bought 2,000 pieces of relaxer. That is your opening inventory, right? Then we have our initial working capital. This is the allocation for payments to vendors and employees in the first few months of operating the business. Pretty straightforward. Then we have benefits. These are other elements of the employee remuneration package. So not just salary, but what is added, right, to the employee's package. Um, Expected to cover maybe medical insurance, allowances, pension, training, development, etc. Then we have business development. This refers to personnel involved in maybe consultations or extensive engagements with customers to identify the best fit product or service before sales can be made. Direct costs. We spoke about direct costs today, and I explained it. So these are costs associated with input and labor required to develop your product or service. So we also have factory overheads for those of us who are into production, right? This covers costs associated with your manufacturing, such as electricity, rent for the factory, maintenance, insurance costs for factory equipment, etc. Then we have administrative. This covers costs such as maybe your office consumables, travel, expenses associated with legal or accounting activities. Have receivable days. This is the average number of days customers take to pay your business for a service rendered. So, for example, with our hair care person, just to make it even clearer, right? Let's say he sells maybe 2 cartons or 50 cartons of relaxer to a salon on credit with the hope that in 30 or 60 days or 90 days, they will pay him the money because in some cases it's not immediately that you receive funds for anything you have sold. So that amount of money for those 50 cartons of relaxer is what we call receivables, and those number of days, maybe 30, 60, or 90, those are the receivable days, right? Then payable days, average number of days that your company takes to pay your suppliers. So let's assume we are the salon now that is getting all the 50 cartons of relaxer. So this company or this organization might have given us 30 days to pay, 60 days to pay, 90 days to pay. Those are our payable dates. Now, inventory days. These are the average number of days required for your business to sell one batch of inventory, right? So if you have 50 cartons of relaxer, for example, what is the number of days for you to be able to clear them all off the shelf? So we also have grants. We know what grants are. money provided as gifts or donation with no condition for you to pay back, or as part ownership of the business. They can come from your family, they can come from your friends, they can come from other sources. Equity, money given to the business by venture capitalists or other sources in exchange for part ownership or shares in the business. And finally, debt, money that is borrowed from a bank or other lending institution that must be paid back with interest at a future date. So let's try to, have this in mind as we start. So first, let's go to the assumptions, right? So the assumptions is basically you kind of taking guesses or using, I don't want to say guesses, but using real life research. How do I put this in a way that would okay, let's start. Then I think it will be clear along the line as we go. So what we started, this is an Excel sheet, and you're going to put in your business country and business currency. So this is supposed to be Nigeria. I don't know why it's showing two, but this is also supposed to be Naira. So for this sheet, or this financial modeling sheet, we're going to be using 3 products. And I use this for my skincare business, just so we are clear. That's why you're seeing things like soap, scrub, and oil, right? So this is where we're imputing assumptions of everything that is going to happen practically in the business, right? So first of all, we can see company tax rate, 30%, which is a standard, right? Bank interest rate, we put it at 22%, but I think now it's even up to 24 or 25%. This was in 2019, mind you. So just keep that in mind. Inflation rate. So it's kind of, thinking of everything that is going on in the economy that can affect your revenue in one way or the other, and putting it here. So here you're putting the inflation rate, or we put the inflation rate. So now we're going to go down to start looking at depreciation rates. Do we know what depreciation means? I think this was explained during the financial section of the business plan workshop. I believe we all know what depreciation means. I want to strongly believe we all know. So now we're looking at depreciation rates when it comes to building. How long would it take for maybe the building you are using or the warehouse you are using to depreciate? And we're going to put it in percentage. Here we used 5%. Next we asked how long, or what is the percentage rate that your furniture would depreciate? We said 15%, because if you compare furniture to maybe a house, you use a furniture every single day. Maybe you're sitting on it, you're using it for one thing or the other. So it's more fragile and more frail, right? Compared to a building. It's not like you're going to use a hammer on the wall that's going to make it, depreciate fast, right? So that's why for building, you can see it's less, it's just 5%. And for furniture, you can see 15%. Now, equipment and machinery, we put 25% here, but it may not be necessary depending on your industry. Remember, this is a manufacturing industry we're working with, where we are manufacturing our own soaps, our own scrubs, our own oils, right? So we said this is how long, or this is the specific percentage that we expect that this machinery would depreciate. We also put vehicles. How long would it take for these vehicles to depreciate, or what is the rate? We put 20%, and then installations, we put 10%. There are standards for all of these things depending on your industry. So you can just do a little bit of research to know. But things like the company tax, bank rates, inflation rates, they are pretty standard for every industry. So now we are now going to go to the growth rate, right? So what does this part say, or what does it mean? Enter the expected yearly growth rates for your business below. You can use the growth rates to demonstrate projected expansion plans for your business. So remember when I was talking earlier and I said it's possible that your business, gets 10% growth every month from what you have noticed or from the data you have kept. You have seen that in January you had 10 customers, in February you had 11 customers, in March you had 12 customers. So you know that month on month, um, you are getting a 10% growth in customers, right? So now you're going to come and do for year. Even though this is more complicated, this we had to do for 10 years, right? But for you, you're just going to do 3 years. And I don't want to confuse us too much with this. So let's just go, let's just see how it looks. And the main thing I want us to see is the income statement, the cash flow statement, the balance sheet. So you can see all the products I put up there, which are soap, scrub, and oil, are visible here. So the first thing is revenue. How am I expecting my revenue to grow year on year? Which is going to be covering my sales volume, as we can see here, and price. How am I expecting my sales volume? And we're using percentage here. How am I how am I expecting my sales volume to grow year on year? How am I expecting my soap price to grow year on year? So this is just putting a percentage. Year one, I'm expecting it to grow by just 0%, right? So maybe my sales volume is going to be constant. Every month I'm doing 50 or 100 products. By year two, I expect it to grow by 20%, right? So if I'm doing 100 products every month in year one, then that means in year two, I should start doing 120. You can see year three, I'm still expecting to do 120. In year four, I now expect that, okay, I'll now receive a 25% growth from that. So it's just an educated guess, right? That's basically assumptions, things that are realistic and possible. Then we also go to the price. How am I expecting my price to increase year on year? You can see year one is 0%. By year two, I'm expecting my price to grow by 10%, right? In year three, I'm expecting my price to grow from by 5. Because in the end, honestly, our prices might not be the same, maybe due to inflation, maybe due to cost of raw material. So you're just being realistic about this thing. How is it going to grow? And you need to understand all of these aspects, right? So that you can accurately do your financial breakdown. So this is it for, you can see I put soap, I put scrub, I put oil. That is for each product. So for you, you may need to list each and every one of your products and do this for it. And then we go to the costs, right? How am I expecting my costs to grow year on year? So my direct cost, I said 20% in year one, 10% in year two. I expect it to grow by 10% in year three because this is realistic. My salaries, how do I expect it to grow? 0% in year one. That's the salaries that I'm paying my staff. 0% in year two. And by year three, I plan to do a 10% increase. My rent, how am I expecting it to grow? Right? In this case, by year one, 0%, my rent will still remain the same. By year two, 0%, my rent will still remain the same. By year three, 0%. And it's by year four that my rent will now increase by 30%. This is realistic and it is possible. Utilities. I expect that by year one, maybe to be a 5% increase. Maybe NEPA will increase my light bill by 5%. By year two, another 5% increase. So, you just have to put the expectations out there or the assumptions out there. So down to your administrative, you can see maintenance, you can see insurance, you can see transport, you can see your subscriptions and licenses. And as you can see, we didn't just do 3 years, we did for 10 years. So it involved a whole lot of research, a whole lot of research. So now let's go to the next section, which is our startup costs, right? And just so you don't know what utilities are, for example, your cost of electricity, maybe cost of water, if you use gas, if you use internet, your data, credit, all of this stuff. So now let's go to the startup costs. So where to enter the costs you expect to incur in the process of setting up your business, right? So I don't want us all these gray areas, we did not feel it, right? So we filled, for example, land. Are you paying for land or are you purchasing land? If you are, then you put the cost there. Next is building or civil works. If you rent a shop, are you going to repaint the shop? Are you going to beautify it? All this kind of stuff. Do you want to break part of the wall and replace it with glass? What do you want to do? And how much will it cost? This is where you put it. And because this has a formula, it will show you how the increase would go year on year based on the percentages that we have put up here. So let me go back. So now you can see that I said my furnitures and fittings will cost me 150,000. You can see in year one, I'm only spending 150,000. And I don't get to spend money on it again until year 7. And after year 7, I don't think I get to spend money again, maybe until year 14. Those are the assumptions that I'm giving. Now, does this mean this is exactly what might happen in real life? No. Maybe my furniture might break by year 2. But realistically thinking, if I plan to purchase this furniture, I expect to purchase something good that it will last me up to year 7. Next is my machinery and equipment. I said I'm spending 250,000 on that. Remember, this is in 2019, so it might not be realistic now. You can see year 1, I'm still doing 250K. But by year 3, if I were to replace any machine, sorry, year 4, it will cost me 393,379. Let's just say 394,000 practically, right? Based on the assumptions that I have put up there. And we can see that by year 8, maybe because of inflation or whatever, right? If I was to replace that same piece of equipment or machinery, it will be costing me 618,000. So this is just how revenue modeling works. It's like looking into the future and taking an educated guess based on what you are doing currently and how the economy is, going currently. And please, if you have any questions, just drop it in the chat so that I can come back and answer. You can see vehicles too. You can see installations, internet, utility. Maybe if you're using maybe fiber, for example, that will come and have to install the wires in your house. How much is it going to cost? This is basically how much are you spending on. And now you can see that we have the opening inventory, initial working capital, and contingency. So now, based on everything that you have put previously, right, it calculates it for you. And you can see that in this case, my opening inventory is 276,000 naira. Remember, we read what opening inventory means. So it means this is what it's going to cost me to do my opening inventory. My initial working capital, 2.5 million. And now contingency, I said my contingency would be 10%. So that is why I have 363,500. And now that gives me a total of 820,000 naira. Now, just to say what opening inventory and initial capital is, the opening inventory allocation for purchase of initial stock of products for sale or service to be delivered in the first few months of operating the business. Initial working capital is allocation for payments to vendors and employees in the first few months of operating the business. So by the time we're done calculating all our costs, right? All our costs. Then we will now go to the headcount analysis. This is basically how much salaries you're going to be paying, right? So enter the salary and number of employees you expect for each key function, right? So benefits. So what percentage do you want these benefits? Remember we said benefits are the extra things that you give. That's not salary, maybe health insurance, travel allowance or something. So what percentage of their salaries do you want to be their benefits? This is just so that the sheet can, update with all the formulas. So we said 0.1% of their salary. So they now ask us, okay, in senior management, how many people are we going to have and how much are we going to be paying them? So you can see number of employees, you can see one. So one in year one in year two, we'll still have 1 year 3. So if you are putting different numbers, right, it's going to multiply by the number of people. So if you're paying one person 900,000 annually, it's going to do in year one 900,000 times one. If you put 5 senior management employees here, it's going to be 900,000 annual salary times 5. So it will show you what you're going to do year on year. So in the end, total salaries for senior management will now be 990,000 naira because they are also going to be getting 0.10% benefits. So this is just showing what type of employees you're going to have. Are you going to have someone in business development? How many are they going to be? Who is going to be the manager? Who is going to be an associate? And how much are their salaries? Right, just to calculate the total number of employees and how much you're going to pay them. So these are all things that you need to put into consideration when doing your financial modeling, right? To get your projections. So you can see sales and customer support. Are you going to hire these people by year 2? Are you going to hire 5? By year 3, are you going to hire 12? How much is their salary? Because all of these things affect your projections. In marketing, are you going to hire, will you have marketing manager, will you have marketing associates, right? How many managers are you going to have, how many associates are you going to have, and how much are you going to pay them, right? So when you understand and put all of these details in, you can now know the total amount of salaries that you are going to be paying. So moving on from salaries, we now have operating costs. You can see that this is just a larger picture of everything I had discussed previously, right? So now you have your operating costs. How much are you going to be spending, right? So we said baseline. For raw materials, for example, we're going to be doing 250K, right? Remember, this was 2019. So 250K could buy you a lot of raw materials, right? And you can see that by year 1, it has increased to 300,000 naira. By year 2, that's the end of year 2, we're paying 330 for that same amount or that same number of raw materials, even for direct labor, even for factory overheads. You can see that over time, based on the percentage that we believe that these costs are going to grow, right? Maybe due to inflation and different factors, you can see that year on year you are having an accurate figure of how these things are going to grow and how your revenue is going to be affected. You can see salaries and wages. We could not edit it here because we had already imputed. Let me go back. We had already imputed everything here, the kinds of people we're going to have, how much we're paying them per year, and all of that. So we can see that salaries for year one, we can see we would be paying about 3 million naira in salaries. By year two, it's still 3 million. But by year three, you can see that it has increased based on the data we had put previously. Same with rent, same with utilities, same with marketing. You can see it increases over time based on the educated guess that we said, okay, due to inflation or due to this factor or that factor, it's going to increase by this percent. Same with marketing, our administrative, our maintenance, our insurance, transport licenses, everything. So you have to really sit down and think and calculate every single thing for your 3-year projections, right? So next, now, I think this is the part I even wanted us to look at. You can see for different products, let's say soap, right? The very first soap. You can see base monthly sales volume. That's how much how many do I plan to sell in a month? And I said monthly, based on my analysis or my recent data, be this month or the past few months, I have done 75 on average. That means every month they are buying 75, right? And the base price or the unit price of my products, remember we spoke about unit price, is 4,500 naira for a jar of maybe 500 milligram of black soap, right? So now we're going to now think, okay, what is the seasonality of these products and what is the reason for the seasonality, right? So you can see here that monthly revenue may vary due to seasonal trends such as maybe holidays, festivities, seasonal discounts and promos, off-peak season. So these are all of the things you have to think of when doing your revenue projections. And this, the only way you can think is if you have a proper plan, because when you say, you cannot just start out in January and decide that, okay, in March you're going to do sales, right? As a proper structured business, you should have your year planned out. You should know that, okay, by April we want to do sales, right? So we're envisioning that our products are going to we're going to get more customers or more sales in the month of April, right? So that's basically what seasonality is. And as you can see here, I said in January, I'm only selling 45%. So that means I'm only doing 33 or 34 products. And why am I doing just 33 or 34 products? Because there's not like 33.75. It's because people spent a lot on Christmas holidays and school fees. So January, I may not have, a lot of customers. February too, I may not have a lot of customers, maybe just 50% of my projected sales volume, right? I'm getting just 37 or 38 sales that month because people have spent on school fees, they've bought their children books and all of that. So they don't really have time for skincare. If you're a food business, for example, it might not really change for you because people need to eat, right? So you might still be doing as much sales month on month. March, you can see I'm now doing 60, which is 80% of my proposed or my estimated sales volume. While why? Because normal customer purchase per month, right? You can see April is Easter. So I did an Easter promo and you can see that I sold 90, even more than I planned or more than my base sale or more than my average sale volume. So these are some of the things that can affect, your projections, right? So do you have a seasonal product? Maybe you only sell Christmas trees. You know that it's only in December that you're going to make a lot of your sales because your product is seasonal. So these are the things that you really need to think. And there are some businesses, maybe it's in December that every family right? Maybe if you sell attachment, it's December that people want to make hair the most because Christmas is coming. Everybody is, making their hair. So your attachment sales will peak at that period. So these are some of the things you think when making your assumptions, right? January, February, March, April, how much do you assume or how many do you assume you're going to sell? That is all about seasonality of the products. Let me see what else is here. This is still all seasonality of all the individual products. So here we have working capital, and we're talking about the receivable days, payable days, inventory days. So we just put it up here. So if you're a business that maybe um, you sell on credit or you buy on credit, right? This
Asking you, okay, receivable days. What are the average number of days it takes your customer to pay you? So you put it here because all of these things affect your revenue. Because for example, or should I say affect your cash flow, right? Because if you have to wait 60 or 90 days to receive money, that's an issue. Or if you have to wait 60 or 90 days to pay money, right? It affects how your money flows, and it's just for the calculation of this. And then startup financing for those of us who are raising money, which was the major purpose of creating these projections. You can see that, okay, are you going to raise money through personal savings? How much of your personal savings are you going to put? So you already know the total amount you're raising, right? So maybe you need 10 million, maybe you need 15 million, right? How much of your personal savings are you going to push into this? Is it 30%? Like me, I said 30% of my capital, and I'm depending on 70% of grants. So are you going to use equity? Are you going to use debt? Are you going to borrow money? So you have to put all of these things in for your income statement. So if you had maybe done equity or debt, these other two sections would have concerned us. But because I'm not doing any equity or I'm not doing debt financing, I'm not borrowing money, two sections did not concern me. If not, I would have had to say, okay, this is how much I'm borrowing, and this is when I plan to repay. And all these things will now reflect on the income statement. Let me see. I hope we're following. Is it too complicated? Let me know on the chat. So this is simply assumptions, right, for your projections. So all of this just shows everything that we had filled previously. So let me go to the income statement. You can now see on my income statement, you can see everything, right? So from all that I've done, all the number of products I'm selling at the end of the year, we can come and see that my gross profits, that is just revenue minus costs. You can see that I have projected that by year one, my gross profit is 6.7 million naira. That's gross profit. But by the time I now pay salaries, by the time I pay rent, by the time I pay utilities, by the time I pay marketing, by the time I pay administrative, by the time I pay maintenance, everything, you can now see that my operating profits. So the revenue I made, yes, I made a lot of money, projected 7.8 million. By the time I remove the direct cost, which is direct cost of producing the product, I'm making 6.7. But by the time I remove all the salaries, wages, everything, you can see my operating profit is now 1.518 million. And then we still have tax. Remember in the beginning, we put percentage of tax. I think it was 30%. So by the time the government now take their 30%, I am left with about 1 million. 1 million in profit. And this is when I can say I have made a profit, because most of us, we just stop at this gross profit. Most of us just stop at this gross profit and say we have made a lot of money. But there's also a lot of other factors, a lot of other things, right? And this is what your investors are looking at: your profit after tax, not your gross profit. Because in the end, the remaining money is not really free money, because rent is dragging it, utilities is dragging it, taxes, all these things. So this is what we're looking for in your projections. We want to see your profit after tax for year 1, 2, and 3. By the way, that is just your income statement. So these are the projections that we're looking for year 1, 2, and 3. But for me, I did for 10 years because TF required us to do for 10 years. And another thing is still seeing your cash flow, right? It's basically seeing how money is going out and coming in the business. So this is your cash flow statement. And finally, balance sheet. So the cash flow statement basically is to see how much cash you have left in the bank at the end of the year. So you can see for us now, though we made profit of, how much was it? 1 point what? 1.062. Can see the actual cash that we would have in the bank would be 972,000 by year 1. And then finally, balance sheets just shows your assets and liabilities. So these things now show the full picture of your company. So by the time an investor looks at this, he will know the health of your company, if it is worth investing in or not. So balance sheet shows your assets and liabilities. So for example, if we had taken a loan, they are going to see it here. So our asset is more like our inventory. That's the products we have on the shelves, right? The cash that we have, our accounts receivable, all the money that is coming in. Well, liabilities, we did not take any loans. What else? We do not have any accounts payable. Okay, we have a few. And then what else? Investment capital. Then our retained earnings. So that is it simply. But the major thing we need on your business plan is to see all of this on your income statement for year 1, 2, and 3. So we want to see like a table with your revenue. We see the products, we see your total revenue, we see your direct costs, we get to your gross profits. And if possible, let's see the salaries, the wages, the rent, utilities, down to your operating profit and your profit after tax. So I believe tax is about 30 to 35% max, but I still think it's 30%. So this is a perfect, straight to the point, simple to understand financial projection. Do we have any questions? Because I know we've taken a lot in this evening. Let me know if we have questions. Or is it clear? Do we understand? Or are we trying to take it all in? This one we are quiet. It's like I've scattered our heads again with too much math, too many complicated things. Do we have questions? And if we don't, I will take our silence as we understand everything. So I believe we fully understand. And I believe that with the picture of this, okay, someone wants.
It's perfect from me. It's
All
really,
right.
really perfect.
All right, beautiful. I'm so glad I've been able to explain it in a very visible way. We can see that this thing is not hard. It's just more time consuming and it requires a bit of thinking, right? So it's something that we can definitely do. Something we can definitely do. And I'm looking forward to all our projections. So I'm going to send out the attendance now. So you see something jump up on your screen, don't cancel it. Just click on yes follow. So would know that you were here. All right. So that is it about financial projections. Remember, you're submitting this section.
Sorry, I did not get the attendance.
Okay. So we've sent it out. We've sent it out. So it should have popped up on your screen.
Sorry, it went off. It went off from my.
Oh, okay. Let's see if we can send it again. So we might not be able to send it again. So just leave a comment. It's a little confusing. Okay. Okay, so maybe because of the internet connection. But when you watch the replay and you watch it over and over again, you'll be able to get it. Just take your time. You can even put it on speed 0.5 instead of 1. So it can be really slow and you take it in. But it's something that over time, it will be easier for you to understand. When I started to, I did not